Hey everybody, it's Joey from Universal CPA Review. Some of you might know me as Ask Joey. If you're studying for the CPA exams and you consider yourself to be more of a visual learner, you've come to the right place. So don't forget to subscribe to our YouTube channel, join our Facebook study groups, and our Reddit community. You can find the links to those in the description below.
Okay, boom, boom, here we go. At this point, we have a fundamental understanding of the difference in how we're going to tax gains and how we're going to tax ordinary income. Okay, so intuitively, we need to understand that ordinary income is getting taxed at a higher tax rate than, say, the sale of investment property. Okay, so ordinary income rates are higher than capital gains rates. Okay, but within the Internal Revenue Code is this important statute that is a sneaky topic on the CPA exam. All right, so we have this hybrid tax treatment for ordinary income and capital gains. And this is going to be referred to as Section 1231 long-term trade or business use assets. Okay, so there are two categories of questions that the exam might ask you. They might ask conceptual related questions or calculation-based questions. So let's dig into it. So let's introduce you to our next company, Take Back Hotels. Take Back Hotels is a hotel company, but more importantly, for the purposes of this lecture, they have a variety of assets on their balance sheet. So some of the conceptual related questions that the exam might ask will require that you identify the differences in Section 1231 business use assets, capital assets, and ordinary income assets. So let's take a look here at Take Back Hotels' balance sheet, and let's understand the differences in these types of assets while narrowing our focus on the Section 1231 assets. So starting off with the Section 1231 assets. What is a Section 1231 asset? The key characteristics of a Section 1231 asset are as follows. This must be a trade or business use asset. It must be held for more than 1 year, and it can either be real property or personal property. Okay, so let's stop right there and let's focus on this third item. When you think of Section 1231, we're going to bucket these into two other sections. Those two sections will be referred to as Section 1250 and Section 1245. Section 1250 is going to consist of real property. Okay, so that's going to either be buildings or land, whereas Section 1245 is going to be personal property. Okay, so personal property is essentially going to be any other fixed asset that is used in the trade or business other than buildings and land. All right, but we're going to come back to this and we're going to drill this down into much more details, right? Don't you worry. Okay, so circling back to Take Back Hotels. We now know that the hotel building, the hotel furniture, and the hotel equipment are all going to be classified as Section 1231. Okay, so that is good to know. But if we're going to break this out even further, we need to note that the hotel building is Section 1250, whereas hotel furniture and hotel equipment are going to be considered Section 1245. But the more important area that I want to focus your attention on is identifying the differences in Section 1231 versus capital assets, right? You might be thinking, but Joey, it seems like selling fixed assets would be capital in nature. Yes, well, this is very similar. Where the difference is going to lie is going to be how the asset was used. Okay, so Section 1231 assets are going to be those that were used in the company's trade or business, whereas capital assets are going to be either investment property or personal property. So if we look at the balance sheet, we see additional land, but this land was held to build owners' quarters. Okay, so this is considered personal use of the land, right? This isn't land that is used to operate the business. So it's capital in nature. Stock is another great example, right? If the company had stock that they sold and that stock was used as an investment, right? It's not like these are traders or stockbrokers. That would make the stock capital in nature. Okay, it's investment use. So it's got to be trade or business use in order to be Section 1231. And that's the difference between a capital asset versus Section 1231. All right, but let's not forget about ordinary income assets. Okay, so these assets are your good old-fashioned current assets on the balance sheet, right? They're not going to be capital in nature and they're not trade or business use assets. So we're talking about cash, accounts receivable, inventories. Remember, they have to be a trade or business use asset and they need to be held for over 1 year, 12 months or more. Okay, so that's how we're going to classify Section 1231. Okay, section 1231 assets. Here we go. Conceptually, we need to be able to identify what types of assets this section 1231 will consist of. Okay, and just to reiterate, these are trader business use assets and those assets that are held for over 1 year. So that is the easy part. Now let's understand how section 1231 gains and losses will be calculated. So at the end of the day, we need to know that we have section 1231, which is broken out into section 1245 and section 1250. But for exam purposes, I want you to think of section 1231 as its own separate category. So at the end of the day, the exam is going to test section 1231, but you need to think of this as a good thing for the taxpayer. And why would that be? Well, we ultimately are calculating net section 1231 gains. So when I say net, I mean we're going to take all of our section 1231 gains and all of our section 1231 losses, and we're going to net them together. If we have a section 1231 gain, this is going to be treated as a long-term capital gain, aka not ordinary income. So let's stop right there. Why would that be a good thing for the taxpayer? Because capital gains will be taxed at a lower tax rate than ordinary income. And if we have a section 1231 loss, what we're going to do is take this loss and treat it as an ordinary loss. And now why would that be a good thing for the taxpayer? Because ordinary losses can be used to offset ordinary income. Ordinary income is taxed at a higher tax rate. So by offsetting this, we're bringing down that total ordinary income amount that is getting taxed. So that is a good thing for the taxpayer. Okay, so now let's get down to business and understand how it is we're going to calculate our net section 1231 gains and losses. So we're going to pull out our section 1231 mental map. And we're going to use this mental map as a guide for our calculation type questions that we quite possibly will see in either a multiple choice question or a task-based simulation. So very simply put, we need to be able to calculate section 1231 gains and section 1231 losses, and we need to know how they're going to get treated. So as we previously said, we're going to think of section 1231 as a hybrid recognition, right? We're not necessarily going to recognize this entire gain as a capital gain. So what do I mean by that? Well, we're going to introduce the concept of recapture. And basically what we're saying here is the IRS is telling the seller of this section 1231 asset that yes, we will allow you to treat your net section 1231 gain as a long-term capital gain, but only to the extent that it meets certain criteria. So as you can see in step 2 in our mental map, we're going to introduce what's referred to as the 5-year look-back rule. And this is something that is specific to only section 1231. Okay, so when we think about section 1231, we're thinking about recapturing section 1231 losses. So when we break out section 1245 and section 1250, we're focusing more on the recapturing of accumulated depreciation. So in step 1, Take Back Hotels is going to calculate that net section 1231 gain for the current year, right? So let's say that Take Back Hotels sold a variety of business use assets in the current year. They have section 1231 gains and section 1231 losses from the sale of trader business use assets. So they're going to take all of their section 1231 gains in the current year and all of those section 1231 losses in the current year, and let's say that they have a net section 1231 gain. So now we need to ask ourselves, how is Take Back Hotels going to treat this net section 1231 gain? Will it be a long-term capital gain? Is it going to get taxed as ordinary income? Well, this is where step 2 comes into play. Okay, so we need to apply the 5-year look-back rule. What the hell is the 5-year look-back rule? Right, that sounds made up. Well, it's important to note that the IRS is saying that the taxpayer needs to look back to the previous 5 years and determine if any section 1231 losses existed. If they did, what that means is Take Back Hotels took those 1231 losses as ordinary losses in previous years, meaning they offset ordinary income. So now what the IRS is saying is not so fast, Take Back Hotels. We're not just going to let you take this entire gain and tax it as a long-term capital gain, since you deducted ordinary income with those section 1231 losses in previous years, specifically within the last 5 years. So the IRS is saying we're going to take back our ordinary income tax revenue. So when you think about Take Back Hotels, you're thinking about the IRS taking back its money. All right, so if you're confused, let's slow this thing down and focus on what is exactly happening mathematically in step 1. We calculated Section 1231 gains in the current year. Fine. Now in step 2, we're going to look back to the previous 5 years to see if any Section 1231 losses existed. Boom. Here we see that they did. What that means is, in step 3, we're going to record part of this gain as a long-term capital gain and part of it as ordinary income. So the portion of this gain that amounted to Section 1231 losses within the previous 5 years is going to be recorded as ordinary income, right? The IRS is taking back its money, and anything in excess of those Section 1231 losses that were recaptured will be recorded as Section 1231 gains, which we remember is good for the taxpayer. Why again? Because that's the portion that is getting treated as a long-term capital gain. Those are going to be lower rates than ordinary income tax rates. Okay, so let's go through an example to see this with real numbers. Okay, so Take Back Hotels, Inc., an elected C corporation, acquired assets that are used in the trade or business in year 1. The property had an original cost of $300,000. In year 4, Take Back Hotels recognized an unrecaptured Section 1231 loss in the amount of $45,000. In year 6, Take Back Hotels sold the property for $280,000 and had $100,000 of accumulated depreciation at the date of the sale. So we want to know, how will Take Back Hotels recognize the gain from the sale in the current year? So again, in step 1, we're focused on the current year net Section 1231 gain. Okay, so it looks like only one asset was sold. So we sold this asset for $280,000. So what was the book value of this asset? Well, the original cost was $300,000 and the accumulated depreciation was $100,000. So $200,000 is the book value at the time of the sale. So it was sold for $280,000 with a book value of $200,000. That gives us a gain of $80,000. So now the question becomes, how are we going to recognize this gain? And because it meets the Section 1231 criteria, right, it's a business use asset that's been held for more than 1 year, we now have to think about the recapture rules, right? Remember, the IRS is going to take back its money from Take Back Hotels. And when this is a Section 1231 gain that we're calculating, we need to apply the 5-year look-back rule. So when it comes to Section 1231, what is it that we're recapturing? We're going to recapture any net Section 1231 losses within the previous 5 years. Okay, so we know that we had a net Section 1231 loss in year 4 in the amount of $45,000. This is the amount that is getting recaptured and will therefore be recognized as ordinary income. Okay, so after we have made that determination, we still have $35,000 from this gain that remains. This is the portion that is going to get recognized as the Section 1231 gain, which will be recorded as a long-term capital gain. This is the good part for the taxpayer.